Hi, I'm Jim Smith from Pacific Wealth, and today we're tackling a big question for those approaching retirement. How much can you safely withdraw from your savings each year without running out of money during retirement? This is what we call sustainable withdrawal rates. Let's break it down. The first step in retirement planning is understanding how much income you will need to maintain your lifestyle. The New Zealand Retirement Expenditure Guidelines provide some useful reference points. The study defines a no-frills and choices retirement respectively. The no-frills is intended to reflect a basic standard of living and includes few, if any, luxuries, whereas the choices retirement income is intended to represent a more comfortable standard of living which includes some luxuries or treats. According to the latest data, a two-person household in a metro area would need around $47,000 per year for a no-frills retirement and about $90,000 per year for a more comfortable choices retirement. If you're a single person, those numbers are $36,000 and $40,000 per year respectively. What you will need in retirement will be unique to you and your situation. You may be happy with less than no frills, or the choices income may not be enough. But either way, the Retirement Expenditure Guidelines provide some useful reference points. A common sustainable withdrawal rate is 4%, assuming retirement is at age 65. This means you can withdraw 4% of your initial investment portfolio each year, and you can adjust this upwards for inflation so that the income maintains its real value. If you retire with $500,000 of investments, this will give you $20,000 per year as a regular income, which will be paid in addition to New Zealand Super or any foreign government pensions you may receive. Based on a starting value of $500,000, this chart shows the projected real value of the investment assets over time, which is adjusted for the expected effects of inflation. It shows that the portfolio may last to age 100 with the $20,000 per year of withdrawals, and assuming a moderate level of risk, of which around 50% of the portfolio will invest in growth assets like shares and 50% in defensive assets like cash and fixed interest bonds. To help illustrate the risk of the portfolio, we can perform a Monte Carlo projection. This shows the projected value of the portfolio at different confidence levels. Here we show the 25th, the 50th and 75th percentiles, which you can think of as being a low, mid and high projection. But note that 25% of the outcomes will be lower than the 25th percentile, so depending upon how long you live, there is a risk you could run out of money. This means you will need to keep your withdrawals under review and be prepared to adjust your spending over time to ensure that you don't run out. Perhaps the most common sustainable withdrawal rate used in New Zealand is 5%. This means you withdraw 5% of your initial retirement portfolio each year if retiring at age 65, but do not make any adjustments each year for inflation. If you retire with a $500,000 portfolio, this will give you a higher starting income of $25,000 per year, but the spendable value of this will be reduced over time due to the effects of inflation. If you look at the typical pattern of retirement expenditure, most people tend to spend more in their early retirement, which then gradually tapers off as they become less active over time. The 5% withdrawal method may therefore align to this expenditure pattern by giving you a higher spendable income early on when you'll be most active. This chart shows the projected value in nominal terms, which means that we have made no allowance for inflation. If we look at the Monte Carlo projection, we can see that this method, based on a flat 5% withdrawal of the initial funds with no adjustments for inflation, provides a similar probability of running out of money compared to the 4% method we showed earlier, which incorporated adjustments for inflation. If you delay your retirement plans to say age 70, you will be able to take a higher level of income from your investments. The 6% rule means you withdraw 6% of your initial retirement portfolio each year if retiring at age 70, and similar to the 5% rule, do not make any upward adjustments each year for inflation. If you retire with $500,000, this will give you a higher starting income of $30,000 per year, but again, the spendable value of this will be reduced over time. If we look at the straight line projection in nominal terms, the portfolio may last until your late 90s, and from the Monte Carlo projection, we can see there are similar probabilities of running out earlier compared to the other methods. Rather than spending your investments over time, if instead you want to try and preserve the real value of your investments, Perhaps you want to pass your investments on to the next generation, or maybe you don't like the idea of spending your capital, then you will need to adopt a more conservative withdrawal rate, perhaps around 2%. If you retire with a $500,000 fund, this will give you $10,000 per year of income. This method therefore comes with a rather heavy price tag, requiring approximately twice the starting level of assets to provide the same level of income compared to the 4% method. But as we can see from the straight line projection, which is shown in real terms, it should preserve the real value of the capital, and from the Monte Carlo projection, we can see that there is very little chance of ever running out of money. A summary of the different withdrawal rates is shown in this table, together with the initial income levels based upon an initial portfolio of $500,000. Your chosen withdrawal rate should align to your lifestyle goals and your risk tolerance. If you withdraw too aggressively, you risk running out of money too soon. If you withdraw too little, you may not fully enjoy your retirement. Finding the right balance is key, as well as keeping your situation under review and be willing to adapt. Your retirement income should be carefully planned using a mix of New Zealand Super, private pensions or KiwiSaver, and other investments to suit your individual needs. Remember, retirement isn't likely to be a single phase of life. It's a journey and things will evolve over time. Planning ahead and being prepared to make adjustments will help ensure you have a secure and enjoyable retirement. If you are interested to learn more about investing or moving to New Zealand, we've created other videos that you can explore on our YouTube channel. You can also visit our website www.pacificwealth.co.nz, and if you have any questions, please feel free to reach out to myself or a member of the team. Thank you for watching.